happened with COVID. We had so many businesses all of a sudden that were flourishing, and then a lot of people took a big hit during the COVID years. So it can
Or
have
if
a
your
really big
business was,
difference.
those tape backups for your computers, and now everybody's in the cloud, maybe it's nothing or less than nothing,
Just different ways of operating your business changes how it can be valued.
right?
Sometimes for the best, sometimes not so much for the best. Also, this is where we start looking at market conditions. So, for example, you may have somebody that on the date of marriage, they had a printing company. Well, if you had a printing company that printed books and magazines and things like that, in today's market, it's not worth the same thing. We don't print the same way. We're very much a digital community now rather than a print-based community. So it's going to have a really big difference on how your business is going to be valued. It's going to be looked at differently.
I know when we're mid-COVID, it seemed the common theme for a lot of the cases I was involved in, we just put that part on hold. We didn't know what was going to happen with the market, and it was too unpredictable to put a number on this business. Jason, I assume things have stabilized now, but was that your experience during COVID, where some business valuations would just be put on hold because we couldn't understand what was happening with the market?
Yeah, absolutely. I mean, there was a lot of uncertainty there, so people were putting a pause on things until they sort of could figure out what was going on and how they were going to react to the situation.
Right. And data separation, Carrie, that's legislated, right? That's your
Yeah.
evaluation date.
We need to have a date that we're valuing things. It can't just be a floating date. Now, the thing that we also have to look at, though, remember, is when we're looking at the business, one of the first things, data separation is really important, but how is that business being owned? If it's owned by one individual, that data separation is really important for one meeting. If it's jointly owned, we're going to be looking at a more current value. So those dates are really important for us to know what's going to happen and what we're going to be looking at. I have one quick question though for you, Jason. Um, are we still looking at a hangover effect from our COVID days, or the hangover effect, is it gone now?
I, I think it depends on the company and the situation. I mean, you have to consider it, but I think by and large, people have gotten past it. I think, a lot of people and businesses have gone out of business as a result, but the ones that have survived up until now, I think they're seeing things return to somewhat normal.
Which is great.
Yeah. All right. Let's see what our audience thinks about our second poll question. How familiar are you with the process of business valuations? And then we're going to get into our next topic. What we got here? Very familiar, 12%, somewhat familiar, 52%, not familiar at all, 36%. So well, you got lots to cover. Thank you for participating. One more quick poll, and then we're going to get into some meat and potatoes. Poll number 3, should all businesses be treated equally? So this is kind of an interesting question, but we'll see what our audience thinks on that poll in a moment. Initial steps. So who owns the business and what's the structure of the business? So I came onto this case, and it was already being litigated in the provincial court. And I'm thinking, why are we in provincial court? They're dealing with parenting issues. I think there's a business, there's all these assets. Let's get at it, right? Let's get up to the Superior Court and start dividing this stuff up. Overly confident, overly optimistic. We ended up turning it into a collaborative process. Thank God we did, because I completely misunderstood the case initially, because I thought the husband owned the business and he had operated it for 20 years, presented himself to the community as if he was the owner. Once we got into the weeds and dug into it, he didn't own it. His dad owned it, and he never transferred the ownership to his son. So we had all these, potential trust and equity claims and ownership issues around the business. So first question, who owns the business, right? Like, you may think that, or maybe the business is owned by a holding company that's owned by another company, and you've got all these corporations. You have other shareholders. So you want to nail down the corporate structure, find out who's actually owns. Maybe your client owns the business and he or she doesn't know it, and they're directors and they set it up that way 30 years ago and never participated in the business. Really important question. Partnerships, another interesting wrinkle when it comes to divorce and business assets. Lots of pros and cons with business partners. And again, I've been involved in both the pros.
Russ freezing up on you.
Yeah.
In this business.
Yeah.
If they're not ordinarily a part, oh, sorry, I'm back. They're not ordinarily I was just saying you have business partners who want to proceed or participate in the proceeding, which is common, makes sense. This is their asset too. But divorce is usually a private affair, and they're usually not brought into the room when negotiations are occurring between the two spouses. So, they certainly have a right to information, a right to participate in some fashion if the decisions are going to affect their business interests. And the benefits also is they provide you with options, right? You may have to sell part of the business or the entire business, and the partner's sitting there ready to assume that role. So another interesting aspect you want to think about when you're evaluating businesses, ownership structure, who owns the business, what's the role partners are going to play, if any, who are the partners? Do you usually, some of them are active, some of them have nothing to do with the business, and try to start thinking through some of those issues when you're looking at divorce and evaluating these assets. So proprietorships are quite common. You have tradespeople with their van full of tools and different items. So Carrie, Jonathan, what do we do with sole proprietors? Or do you want to add to the corporation and the partnership issue and the ownership issue as well? But how would you approach this? You want to go first, Jason?
Yeah, I'm fine. I mean, Russ, you've just illustrated the complexities of the types of cases we can get involved in. So at the outset of every situation, it's important to really take an inventory and understand what businesses are we dealing with here? Are we dealing with a sole proprietorship, a partnership, a corporation? Possibly there's trusts too. You really need to understand that. And when there's corporations, you need to understand the ownership. Like, how many shareholders are we talking about? Are the shareholders related parties? Who is active in the business? How are the decisions made? Are the related parties active in the business? Are the related parties being paid by the business? There's a lot of things you just need to take an assessment of at the very beginning.
Yeah, Carrie?
Yeah, I agree with everything that Jason just said. So often clients are coming into our office and they're saying, I have a business. What do I have to do? And our first job is to look at it and go, okay, you say you have a business, but what does that mean? Like when people say, oh, I own a business, well, are you, knitting baby bonnets and, selling them at a local craft store? Or do you have a bigger corporation where you have a lot of employees and everything else? The idea of business and having one can mean different things to different people. And so there's such a varying degree of that. A lot of our first steps are doing that assessment of saying, okay, you have a business. What type of business? Is it a registered corporation? Is it a partnership? Where did these structures come from? Because we got to know that before we can know what the next steps are. So we've got to start at the beginning and we work our way down the line because they mean different things. And it's a different way of how we're going to be approaching somebody like Jason doing the business valuation. When we're giving that information, he's going to need different information depending on the setup.
Yeah, just by way of an example, like if we're talking about a sole proprietorship, you got to remember these types of business arrangements are more likely to have personal transactions commingled with business transactions, and they're more likely to be less sophisticated with their financial records and reporting. And there's definitely a likelihood of there being less commercially transferable or saleable goodwill.
Yeah, exactly. Let's see what the results of our next poll is while we go to some audience questions. We're having some great questions coming in. So should all businesses be treated equally? Yes, 30%, no, 66. Only if someone plans to keep it. Yeah, that's an interesting. We'll talk about what do you do if you have to sell it or keep it. Only if it's being sold, 2%. So let's go to some Q&A. I want to thank our audience for participating in the polls. They're really insightful to find out what you think about these questions, and also for sending your questions in. Some fantastic questions coming in. So thank you. What about family trusts? This can be difficult, right? Jason, what do you do when a family trust is operating or owning a business? How do you deal
Yeah,
with that?
we could have an entire session talking about family trust, but when you recognize there's a family trust involved, it's important to get the trust agreement, and it's important to understand, who the trustee is or trustees are and who the beneficiaries are and what type of a trust it is and is it their discretion and get financial statements. What does the trust own? Like these are things that you need to gather before you can even sort of understand what to do with the situation.
How is it different than if it's just held by a corporation? Different rules?
If what's held by a
If
corporation.
a family trust holds it or if a corporation holds the business?
Well, the corporation is usually the business, but if the shareholders are direct shareholders in the corporation, usually what you'll see is the trust having an interest in the corporation, right?
Right.
And then that makes it more difficult because how do you allocate that value? The value is owned by the trust, but what is the trust in existence for? There's someone controlling the trust who's the trustee or the trustees making the decisions, and there's someone benefiting from the trust who are the beneficiaries, and they could be income or capital beneficiaries. So it's important to understand that flow of the benefit and who's responsible and in charge of that or in control of that.
Yeah, right. And another great question that came in, how effective are shareholder agreements that exclude FLA, a family law division? Is that effective or not? You have a shareholder agreement, I guess the question is asking, can you contract out of the Family Law Act and the requirement to share your property through a shareholder agreement? I don't think so, but have you had a question like that before?
Wouldn't you need to be having either a prenup or cohabitation agreement or something along those lines that would show it as an exclusion? I know trusts, you can have the part in the trust that the trust says, not to be included for family law purposes, but
Right. So do you look at shareholder agreements quite often, Jason? Do you go that deep when you're looking at evaluating the business?
Yeah, shareholder agreements are important, and a lot of companies don't have shareholder agreements, but we always ask to look at the shareholder agreement because, especially if there are multiple shareholders and we're valuing an individual shareholder's interest in the company, maybe a 40% shareholder, a 50% shareholder, but we want to understand if there's any clauses in the shareholder agreement that allow for like a buyout or a
Yeah.
purchase of the interest. And we want to see if there's any requirement for annual valuations or there may be prior valuations being done in accordance with the shareholder agreement. And particularly if there's a minority interest, like a less than controlling interest in a business, there's an extra factor or discount valuators have to take into account, a minority interest discount. And we need to look at the shareholder agreement in order to assess that.
Right, right. Great questions. Thanks for sending that in. Just to back up to the sole proprietors, I'm thinking about a lot of my clients. Oftentimes, there's personal line of credits that run those businesses too that are attached to the home, right, Carrie?
oh, absolutely. And it's something to watch for. We hear that a lot of times. Well, that's not ours, that belongs to the business. So that should go solely to that person. Um, that's still, helping out your family in the complete way. So I think you just really have to look at it. It's one of the ways, though, I think that collaborative plays a really nice role is because we can look at things maybe a little bit differently. We can, talk about these items where we're saying, okay, this was all about the business. How do we want to deal with it slightly differently? Do we want to, does the person at the end of the day, when they know what the legal model looks like, do they want to exclude it? Do they want to say, no, 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 I'm going to take that away and that's just going to be my debt and we're not going to involve that? So I think those are some of the benefits that collaborative can give us when we're looking at those sole proprietorships.
And sometimes you're just evaluating the debt, right? What's the
Yeah,
liability? Sometimes if
absolutely.
there's CRA arrears or tax arrears and the taxes can quite easily exceed the value of the business. And now you're trying to protect your client from, potential garnishments or attacks on real property by the government.
And at the end of the day, if it's a sole proprietor that was established during the marriage, it's still marital assets and marital liabilities at the end of the
Yeah.
day. It's not going to change that very much. But like I said, collaborative gives you that opportunity to at least have discussions about it in perhaps a different setting than if it was the strict legal model and you're in a courtroom. that's not going to take into maybe some other considerations. One of the things, if I can just go back for 1 second, when we were talking about the question we just had about the shareholder agreements, there are times that we can put into the separation agreement, though, about a shareholder agreement and them going to corporate and having their corporate lawyers and having a shareholder agreement done that'll tie into their separation agreement. We've done that in the past.
Yeah, yeah. There's a question that came in. What do you do when the business is inoperative, but the opposing lawyer is saying it is operative? So what you do about that? Say, okay, well, here you have it. Just give them a business.
I say wrap it up. If it's inoperable, do the right thing and wrap it all up. Get it
Yeah,
done.
yeah. All right, let's talk about how divorce is going to affect the business interests and assets. So what I see quite often, and Jason, I'm sure you see this too, business owners get easily distracted by divorce proceedings. They're excellent at running their business, but when the divorce happens, they get distracted, the business starts to falter. And Carrie and I often talk about this concept of a golden goose. You have this asset that has provided for the family for 20, 30 years and can still provide for the family if it continues to be successful. And oftentimes there's adult children working in the business as well. So we don't want to kill this golden goose, but when you start the proceeding and if the valuation process is overwhelming, that can distract the business owner. They're busy responding to disclosure requests or trying to get bank records or whatever the issue could be. And also, if you force a sale, it might not be a very good market at that time to sell the business. You know, the court's got very limited options. They're going to order it divided or order it sold, and the market may not be suitable for it, or the competitors may be able to access some of the information through the court process in terms of financial statements and business valuations. So what I'm seeing, Jason, there's a lot of risk when a business owner goes through a divorce. What are you experiencing on your end?
Yeah, absolutely. I agree with you on all those points. There are a lot of potential negative effects of divorce on the business. And I think the goal through the process, and if you can agree to this up front, the goal is to try to minimize those potential negative effects on the business because you want the business to continue to go, like you mentioned, the golden goose, right?
Yeah, yeah. Carrie, you want to get in on this at all?
Yeah, I'm agreeing with everything that you guys are saying. One of the things that emotions run so high, and when we have a business, and especially if there's something that happened within the business that caused the marriage to break down, it can cause even further emotional strife and problems. I think it's about people need to start stepping back and looking at what is the long-term goal. And again, in collaborative, we're talking about goals and interests. So if we have somebody that has been running the business, the other person maybe has been a stay-at-home parent, how is this going to work if you destroy the business through this process? That thing or that entity that allowed your family to thrive is no longer going to be there to allow it to thrive. So you got to think about the long-term implications of some of the things that you're demanding or asking for or in consideration.
But the pushback from the clients can be, I want out, right? I don't want anything to do with this business. I don't want any liability.
And that's
I want a
okay.
clean break. Give me my money so I can go buy a home or live on the lake.
But that's when we get creative, right? Let's see how we can do that. How can we structure a settlement so that they are getting that clean break so that we don't destroy the business that has been so beneficial to the family? And we got to look at, are there succession plans for that business? Are there children or other family members that are in that business that this is going to negatively impact their lives too?
Yeah, and we'll get into that. Great point, Carrie. Thank you. So, Jason, I get this question all the time. Do I need to have my business valued? Yeah.
Yeah,
Yeah.
there's a very simple answer. I mean, in a divorce, you need to equalize property. And in order to equalize property, you need to know the value of the property. And so if there's a business, whether it's shares or loans, that's property that needs to be valued as part of that process to prepare the net family property statement to equalize assets.
Yeah. We were in a collaborative meeting and the business owner literally wrote on a napkin, like, three additional corporations that he owned that we didn't even know about. He goes, "Oh yeah, and I also own these three corporate companies." It's like we had no idea. But all right, so we're gonna get it valued. What information do you need, Jason? What do you commonly ask for, and what should we be telling our clients?
Yeah, ultimately, business owners need to know that all information necessary to conduct a proper valuation needs to be disclosed. So this includes the company's financial statements, tax returns, possibly general ledgers, budgets, forecasts, major contracts, information about the compensation to the shareholders and related parties, and a lot of other information about the company's background operations and risk factors. Like we're talking about employees, products, services, customers, competitors, market conditions, all of those things.
What do you do if your client's a tradesperson with a van full of tools and that's it? Like he's the business. All right, do we have to go through this rigmarole and get all these documents, or is there a cleaner way to do it if we don't think the business is going to be worth that much?
Probably not in that situation where it's a sole proprietor and it's one person working out of their truck and no employees, no workforce. Really, there's no value there. The problem is sometimes the spouse doesn't agree,
That's
and you
right.
need to go through the process to prove it or support it. That's the
Yeah.
problem.
Yeah. Let's go to our audience, see what they're thinking. What is your primary concern regarding how divorce can impact business valuations? So you've heard some of our initial thoughts. We'll leave that up for a few moments. Um,
Russ, can I ask Jason another question?
yeah, sure.
Okay.
This you do
Jason,
whatever you want.
what happens if there's proprietary information that that would help with the valuation? How does that come into effect? Because, we do get clients where they're like going, wait a second, this is all about me and my business, and it's really, really important that it keeps within my business. Think of KFC and there's
18 herbs and spices kind of thing.
exactly. Or, like McDonald's special sauce and all of those sorts of things. Like, what happens if there's a proprietary information within all of this?
Yeah, there's always confidential, sensitive, proprietary information. And, when you get an independent valuator involved, they're subject to confidentiality agreement as part of the contract. And that's part of our professional standards. And sometimes even in addition to that, the parties want us to sign an NDA, like a non-disclosure agreement, because we need to get the information we need to do a proper valuation. But, the parties want to be assured that it's not going to get out, right?
So is your preferred then process court or out of court?
Out of court.
Just asking.
Totally.
Let's see what our audience is saying. Primary concern, decrease in value, 9%, disruption in business operations,
Yeah.
50%, legal complexities, yes, 33%, personal impact, yes, it's right across the board. This is the next question, when do you not have to have a formal business valuation? We kind of touched upon this, but Jason, when do you say, okay, we're not doing an evaluation on this?
Yeah, a couple thoughts come to mind. I think you may not need a formal valuation done if both parties agree on the value. Like quite simply, if you both can agree on the value, why do you need to get someone in to tell you what you agree to? So that would
Exactly.
be one situation. Possibly another situation is if there's been a recent transaction, like a recent transaction between third parties of the shares of that company that you're valuing. That could be, at least it warrants a look, but that could be representative of the value.
Yeah. Or a recent sale or offered it by the business that was legitimate.
Yeah. Yeah.
Put it pretty close to the market value.
Yeah, as long as it was done in due course between third parties and went through a process, then that could be representative of market value.
Okay. So next question, I had my business valued for a separate matter. Can I use that valuation for my divorce?
Yeah, I
Maybe
guess
they got valued
that's
for
for me
bank.
again.
Maybe they got that valued for bank financing or something.
Yeah. Yeah, and the way I'd answer it is I'd say possibly, but you definitely need to consider a few things. Like you need to consider what was the valuation date? Was it close to the date that we're looking at, the separation date, or is it very outdated? Because then it's not useful or relevant. What was the purpose of that valuation? And are there any underlying potential biases? Like sometimes for tax purposes, people want a lower value. It could be a lower value. And for purposes of potentially a future sale or negotiation regarding a sale, they want a higher value. So just think about that. Also, who prepared the report? There was another valuation done. Was it done by a CBV or a non-CBV accountant? And also the type of report. Take a look at the type of the report, because there could be some scope limitations, and then it wouldn't be as useful.
All right, lots of audience questions coming in. Thank you so much. Let's answer a couple right now. Is there a rule that says you can gross up corporate income by 30% for purposes of division of assets to reflect preferential tax treatment? What do you do about gross ups, Jason?
Grossing up the value for equalization purposes on the NFP, I'm not really aware of. Like, I know we calculate the gross value and then we take off contingent disposition costs when we talk about
They're saying grossing up corporate income.
corporate income. So for income, that's for support purposes. We're going to talk briefly about that later. But yes, sort of income for support purposes is on a gross employment income equivalent, and there are gross up considerations that have to be taken into account.
I guess the percentage would be dependent on the amount you're grossing up, or the
The
tax.
percentage, it depends on the individual's sort of marginal tax rate.
Right. Got it.
If it's a lower income, it'll be a lower gross up. If it's at the top marginal rate, that'll be the highest gross up.
Let's take a few minutes and go through some more questions. How do you account for businesses that have lots of cash in and out? How is that seen, or how do you deal with that?
Are we talking about cash on hand or cash transactions? Like,
Well, I guess if it's cash and you record it, it's accounted. So I'm assuming
Yeah.
this is cash. You met the guy in the alley, he gave you $500 or something.
yeah, this is the hardest issue to deal with in evaluation and an income assessment is unreported cash, right? And there's a lot of those situations, a lot of companies that are conducive to having those. Like, think about landscapers, contracting companies, hairstylists. Like, I mean, there can be a lot of cash transactions that don't show up in an individual's reported income, but need to be assessed and valued in doing an income assessment or even possibly a business valuation.
And if you live or cottage in a rural or northern community, probably half your transactions are cash, right? It's just commonplace.
Oh yeah.
Lots of great questions. We're going to come back to those in a moment. Thank you for sending them in. Keep sending all your questions in. What different types of reports can we receive, Jason? Or what can you provide?
Yeah, I'll just be brief on this. So as a CBV, a chartered business valuator in Canada, there's 3 different types or levels of valuation reports that we can prepare in accordance with our standards. That's the calculation, the estimate, and the comprehensive. And each one has an incrementally greater sort of scope of review and independent verification of assumptions undertaken by the evaluator. And also each one has a greater cost. Like, it takes longer to do a more thorough investigation. So it typically costs more, and the report is generally a little bit thicker.
Yeah. And we've had you participate in collaborative proceedings and initially just asked for a verbal report to get a flavor in terms of how deep we need to dive into this. And you can participate that way and answer questions. And sometimes it's the most cost effective, I find.
Absolutely, that's an option. We can provide verbal reports. In those situations, we do the same level of work that we would have done if we prepared a written report, except we just do the schedules and we don't prepare the written report in accordance with our standards, because our standards say the report has to have so many sections and stuff in it. And then we just get on a Zoom or Teams or in-person meeting and verbally explain the process and the assumptions and the value conclusions.
So where's the tipping point, Jason? At what point do we say, okay, we need a comprehensive business valuation done for this asset? What would be some of the red lights that are jumping up at you?
Yeah, so first off, I would say that the vast majority of our reports are calculations or estimates. And that's really because it's so time consuming and costly to do a comprehensive report. So Typically, we would do a comprehensive report when there are large dollar values at stake, when the situation is very adversarial or litigious, there's a lack of trust, a significant lack of trust, and significant dollars at stake. There are significant contentious issues that warrant a forensic review. Those are really the situations.
Where there's significant tax issues, right? That it's going to be hard to anticipate or accurately calculate.
Sure.
And those are common.
Mhm.
Let's go back to our audience. We'll run our next poll. What types of business ownerships do you believe is most valuable to the valuation disputes during the divorce process? So, all right. So we'll see what our audience thinks of that poll question. So Jason, another question. What if litigation can take 2, 3, 4, 5 years? And let's say the litigation drags on, you get your business valuation done in year 1, and now you're 3 years out. Do you have to get it updated, or do you get a new valuation? Market can change, the value of the business can change. What do you do at that point?
Yeah, I think it depends. I think if the valuation is required as at a particular date, like the marriage date or the separation date, and those are hard dates, then it doesn't really matter how much time has passed. But if we're talking about a situation where there's joint ownership or possibly claims of a constructive trust or something, then you do need a current date, right? And if time has gone by, it definitely may need to be updated after 2 or 3 years when circumstances have changed.
So can you just update the existing one, or you have to do a fresh one?
You can just update the existing one by getting the more current information.
Okay. I misspoke there. This poll question is, which type of business is most vulnerable is what we want to find out. So let's see what our audience thinks. I got a suspicion what they're going to think. Sole proprietorship, yeah, 49%. Partnership, 18%. Corporation, 26%. LLC, 6%. Thank you for participating. Let's talk about sales, asset sales. When I have clients, in my view, a court-ordered sale should be the last thing you want to do. It might be a fire sale. You might have to sell it at a discount. There may not be a buyer for that particular asset. It may not be tax efficient to sell it. There's a whole number of reasons why I think I would avoid that. There's some people who will stop at nothing. You have to get the court order. You have to sell it. We have litigants like that. But what do you say about public versus privately traded companies, Jason? How are those different? I guess if it's public, you just throw the shares on the market and let the market decide.
Yeah, publicly traded companies, shares in those companies, there's a public market. They're easy to liquidate, right?
Right.
That's an easy one. Privately held companies are more difficult to sell or liquidate. I mean, you need to find a buyer for the company. Typically you need to go through a process, and that takes time. And then even when we're talking about private companies, what if you're talking about a minority interest in a private company? A shareholder only has 10% or 25% of the shares. That's even more difficult to sell or liquidate because you have to wait for a sale of the entire company, or you have to find a buyer for your minority interest. And who wants to buy a minority interest and come in and have no influence or degree of control over the business? I mean, perhaps you could be looking at one or more of the other shareholders. They may derive a benefit by buying your minority interest, but that's if they even want it and if they have the financial resources. So those situations are even more challenging.
Yeah. And I guess that's when the business valuation would be helpful, right? So if you're going to do an asset swap or move assets around rather than go for the discounted sale price, if you can find a buyer, you can just trade the assets, provided you can put a number on it.
Yeah.
Right. Okay, we kind of teased this one a little bit earlier today. Golden goose, Carrie. This is your baby. What are we talking about?
This is my baby. My whole thing is that we want to preserve the company. The golden goose, that's the one that's been providing lifestyle for the family for all these years. It has been doing the best job that it can. Why would you want to destroy your livelihood is just beyond me. I say we get creative. You find out what you can do. I get some people are saying, I want out. I just want to be done with this. I don't want any part of it. And if you're a partner in it, okay, we can understand that we can maybe move things around when we're looking at equalization and when we're looking at settlements, we can move things around. My thing is that again, if this company is going to be dependent on everybody's future, you really need to look at all options to save it. And you need to figure out who to talk to or how to manage your emotional journey as you're going through the process. And, so many people, we see it all the time. They want to cut their nose off to spite their face. And it's kind of like, look at the long term, short term, this might be what is good for you. But there's other options, there's other solutions, and that's when we get into massive amounts of option generation so that we can save that business so that we can ensure the family is looked after and your legacies are looked after.
Yeah, great question that came in. Thank you, Carrie. What what would you expect to pay? You talked about these different types of reports, Jason, or a report written. What is the price range for each one of these tiers? What should clients or lawyers expect in terms of expert fees to get these reports done?
Yeah, it's so difficult. It's so case specific, but I mean, if we're just talking sort of in general, like let's say we're talking about one operating company, only one company, not multiple companies. Holding companies are generally easier, but one operating company that has operations, cash flows, goodwill, you're probably looking for a calculation. It might be 6 or 7 thousand. For an estimate, it might be 8 to 10 thousand. And a comprehensive is it all depends. It's generally over 15 and could be quite high.
All right, so let's run our next poll, Daphne. When you get an opportunity, we'll go through a few more questions that came in. In your opinion, how likely is it that a divorce could negatively affect long-term success of a business? Well, we kind of teased what we think about that one, but let's see what our audience thinks. One question that came in here, what about all the tricks sole proprietors play during a divorce to hide the real value? Interesting, right? This is our clients are always thinking there's a lot more to the business than sometimes there is. What are some of the things we should be looking for, Carrie or Jason?
I love tax returns. For a sole proprietor, they're my best friend. And I think what we're looking for is maybe not hiding the value of the business, because if they're a sole proprietor, they're gonna have, they might have some equipment that is pertaining to it. So for like you said earlier, like tools of the trade kind of thing. I think what we're looking at more is where are they hiding income through their business that they're not disclosing on their tax returns.
Yeah.
Tax returns are wonderful things because they're going to want to get that income down as low as possible. So we're going to look at things that we can add back. So for an example, if somebody's a real estate agent and they have vehicle charges, reasonable that a real estate agent needs their vehicle. But if you have maybe a computer analyst who is sitting in front of a computer 24/7, is having, $15,000 worth of vehicle charges, a little unreasonable. So we want to look at what type of business is this sole proprietorship? Are these expenses reasonable? If somebody is doing something where the travel really wouldn't be a part of it, but they have $20,000 worth of travel, it's kind of a dead giveaway for us that you're running your personal travel and you're running it off, trying to write it off. So like, good for you. But another one that we see a lot of are things like phone bills. So telecommunications, the entire family is being run through the corporation or through the business, and everybody's phone bill, including, their Netflix accounts, are being written off. So we want to look at those things to be adding back for income purposes.
Jason, thoughts on this one?
Yeah, I agree with Carrie for sure. And when you're talking about sole proprietors, it's not usually value they're hiding because there's not usually a lot of commercially saleable value there. It's income. It's income that they're hiding. And if they're reporting $50,000 of gross sales on their income, there could be a lot of unreported cash income there. And plus, they're like Carrie said, they're writing off a lot of personal expenses to get the business income down to pay less tax.
Oh,
Yeah.
and here's the thing. My view is however low you can legally get your income down for CRA purposes, you go for it. Don't be silly. You write that stuff off. If you can do it, you write it up and you get away with it, go for it. But just remember, for family law purposes, we are going to look at that and we're going to add it back.
It's
Yep.
amazing how many business owners only earn $25,000 a year.
Oh, yes.
Yeah.
Yeah.
You know what I like to do, and I'm sure you guys do this too. You look at the financial statement too, right? So their expenses are 110 grand with all, all the bits and pieces that they go through in life, but they're only earning 25,000. Well, how are you making it up,
Yeah.
right? Like
Yeah.
there's a gap there. Some questions, lots of questions coming in on this specific topic. All right, so Jason, I've had this happen all the time. Clients saying there's cash, right? He's making these deals, or the company's got cash and not disclosing it on their books. How do we get to that? What do we do? Like,
Yeah, it's very, very, very difficult. And if you truly want to keep everything off the books, you can. But there are a couple things we can do to sort of investigate or sort of test. Like we can gather all the bank statements for all the bank accounts, look at all the deposits in from various sources. And if all those deposits in don't reconcile to what's being reported as revenue, then you got some explaining to do. And then also on the flip side, you could go through all the credit cards and bank statements and do an analysis of the spending, the expenditures, and what's the personal spending. And if your
yeah,
personal spending is equivalent to 150,000 and you're only reporting 40,000 of income, you got some explaining to do.
and look at the bank records. Sometimes the cash is coming in and out of the bank accounts, right? Through ATMs and other means. So yeah, there's lots there if you want to look for it. So let's see what our audience is thinking. Poll results are coming up here. How likely is it going to affect the business? Very likely 36, somewhat likely 45,
Yeah.
not at all 11%, not sure. So thank you for participating in those polls.
Russ, one of the things I was thinking about with people that are getting paid in cash and doing that, it's getting harder and harder to pay in cash. I don't know about you guys, but I go to a lot of places and they're like, going, we don't accept cash at all anymore. It's debit. Like
Yeah.
they expect the tap and be done with it.
You go to a concert or a sporting event, they're usually cashless stadiums now, right?
Yeah.
It's
Yeah.
all, yeah.
And then you're laughing because you're like, when you don't accept legal tender.
Are you going to charge me $30 for a beer?
Exactly. They're thinking you won't see it because you keep tapping, so you're never going to know
Right,
how
it's
much you've
less
spent.
painful. And then they got the tip option too. You literally walked 2 feet and handed me a drink, and now I got to give you a $6 tip.
Yeah, not happening.
Listen, we're very fortunate to have the opportunities we have. I'm not trying to be that person. Emotional cost, pride of ownership. There's a non-dollar cost to these businesses too, Carrie. And lots of times the lawyers and the financial neutrals don't care or don't consider that aspect of it, but it can prevent a case from selling. So what should we be looking for in terms of the emotional and cost and pride of ownership?
It's actually kind of funny because the emotional costs can go so many different ways. So I have a matter right now where, the one party is going, no, I know this business is running and I know it's making X number of dollars, and they're very adamant about it, and they can't provide us any proof of it. And then on the other side, you have somebody that's going, no, it was a failed business. It has failed for years. I'm not doing that anymore. I'm doing this instead. And the other person's just not hearing it. They've got a blinder on. Sometimes people way overestimate what their businesses they think that it's worth because they have that bravado of, I'm a successful business person. I do great in this. And then they are upset because the business valuation comes in so much lower. Or conversely, they go, oh, my business isn't worth anything. And the business valuation comes in so much higher. And then they're trying to talk it down. Like people are on both sides of this fence. And it's kind of like your business is what it's worth. And that's all there is to it. So you get a really big mix of emotion. And a lot of people, their identity is really tied into their
Yeah,
emotion, into their
yeah.
business. That's who they are.
And we're getting some great questions on this subject. One is, do these become highly litigious, or can collaborative deal with these types of cases?
We can. And you know what? The reason why I do like collaborative when we do have family businesses and it is emotional is when we get that family professional involved. They can help deal with why there is the emotion that's going on behind it. And a lot of time when the emotionality that's going on behind it is fear. is like, wait a second, this person's going to keep this business. They're going to be wildly successful and they're going to do all this stuff and they're going to grow the business. And I'm not going to benefit from any of that, even though I was there in the startup years with the blood, sweat, and tears. So there's that fear that there's going to be an inequality that happens in the future. And how are they okay?
That's also pride too, right? Because that was part of
Yeah.
their identity and now they're not part of that business anymore.
Exactly.
Yeah.
So,
All right. Give us your 30-second elevator pitch, Carrie, on collaborative. We're saying collaborative like everybody knows what we're talking about.
yeah.
What do you mean when you say collaborative?
So
Where
collaborative
do you get the
practice.
training?
Yeah, so meaning that, you know what, you are absolutely not in court. You're agreeing that you're not going to go to court. You still have your lawyers. I like collaborative. Think
So
of it,
this is the process, like mediation, arbitrations,
it
collaborative
is,
practice,
I look at collaborative as the best of all worlds.
right?
So you have your own lawyer and counsel like you would in court. But you have the benefits of mediation where we're going to keep things private. Really great if you own a corporation. So your business information is not going out there for your competitors or anybody else to see, or your nosy neighbors. So it's a really nice close process where we can get very creative. We can say, what does the legal model look like? Now, how can we arrange this so it's the best fit for your family? And if we have lawyers here that don't know about collaborative or want training, we do have training coming up as well. That's happening in October.
Yeah, we'll put a slide up with those dates. Thank you, Carrie. All right, payouts, equalization options. So equalization is obviously a term in the Family Law Act where we share property and do the calculation. Asset swaps, that's quite common, right, Carrie?
Oh, absolutely. Somebody might want to keep the house, the other person's keeping the business. They end up being fairly equal in their value. Great, you keep one, you keep the other, everybody moves on their merry way.
Or it could be a pension as well, you're swapping.
Absolutely. Pensions are another great one that we use. People get really, I'll say possessive about their pensions. It's a lot of blood, sweat, and tears that goes into them.
Yeah, the net family property statement is really effective to understand how you can creatively come with the payout. So you move the assets around, it'll do the calculation will happen. You find out, all right, you keep the business, I'll keep the home. You're now your equalization payment's gone from 1.3 million to 300,000. And then you figure out how that 300,000 is going to be topped up.
Absolutely. And that is one of the benefits of doing this collaboratively is that we can get very creative. We can go, is there a time period that we need? Is there a different movement of assets that can happen? Is there family that's saying, hey, you know what, whatever that bottom line number is, I'm going to help you out and I'm going to pay it for you. And so that it becomes a separate thing altogether.
And sometimes there's a wait and see, right? I know we were involved in the case where really unique home on the water, several $1 million, and there's only a handful of buyers for this home in the country.
Mhm.
We had an idea of what the value was, but we weren't sure. So we decided to wait, right? We would list it and see what the market would bring. So ideally, the payment would have been made sooner, but it was such a big asset, only part of the payment could have been made. And then I think the provision was 7 months, and then if there was no offer, we would agree to transfer it at a fixed price. So that's one option too, right?
Yeah, and we can do that with those kind of items. And it's a big deal right now doing the wait and see, especially when we're looking at something like real estate. The real estate market right now has been so volatile for the past year. We don't know what's going on with rates. We're hoping they're coming down again in September, but the Feds have never been known for always keeping their word on things. So it
Or,
causes volatility when we're trying to reach a settlement.
or if the business is in a unique market situation that is not historically, we can't track it, like COVID may affect that particular industry. So we're
Or
going to wait to see what the market's like
Or they
after
may
that.
be waiting on contracts to come in. Like everybody may say, hey, listen, I know that there's this, and this contracts that are in the works, and they're going to be coming in within the next number of months. So I don't want to settle now. I want to wait until those contracts would come in. I want to know what the impact is.
Unless the contract was negotiated after the date of separation.
That's
And with
true too.
that, there's lots of cases on that too.
That's true
The
too.
business jumps by a couple million.
Yeah,
But that deal happened after the date of separation. You don't capture that value.
yeah,
So you got to be really careful with contracts too.
absolutely.
All right, this is something many family lawyers don't think about, but legacy planning and issue identification. So, we've had a couple cases where this was involved. Do you want to start us off, Carrie or Jason, or?
Go ahead, Carrie.
So, well,
Legacy.
if we're gonna maintain this golden goose, and um, that one spouse is going to say, "Fine, you run the business. I'll pull the earnings and the dividends and the benefits from it, and then we'll divide the equity later if and when it sells." So now you got to do legacy planning. This is, I find, where you get an extra large team involved. You're going to have corporate issues in terms of how this is going to be structured, reporting issues in terms of ongoing financial performance of the company. You've got any, personal benefit that being drawn out of the business, cars, phones, things of this nature. You're going to want to have proper wills done. If the business owner is going to enter into a new partnership with a different spouse, you're going to want to make sure there's a domestic contract drafted that's consistent with the separation agreement or whatever agreement you make with respect to the business, so that new spouse doesn't make any claims. So there's a lot to unpack here, right, Carrie?
Oh, absolutely. And a lot of the stuff that you're talking about is like with the wills can be changed at any time. But if you're saying in your separation agreement that your will must match this, just put the clause in there. Make it as fulsome as possible. If there is succession planning, make sure that the succession plan is tied back to the separation agreement. Sometimes, and we've seen this in the past where people have asked, can we do something where my shares in the company are going to the children so that I know they're going there? I don't necessarily need to see the money now. I'm okay because of all the other assets we have, but I want to make sure that this is going over to the children at a certain point in time. So we can look at those sorts of things as part of the succession planning of the company. A lot of kids or other family members are already working in these companies. And so we want to make sure that they are okay, because as soon as maybe, your son or your daughter is working in your company and they hear mom and dad splitting up, I think their first thing is, well, what happens to me? Not where I'm going to live, maybe, but what happens to my job? What happens to my livelihood? What happens to my family?
Right. I guess that's the great thing about the collaborative process is you can get creative, right?
Right. Well, I always like to say we offer a concierge service. So
Right.
we are tailor making it to the clients and their families. I don't think we've ever done the same deal for a business twice. I think it's always been very creative and something a little bit different. And I know Jason has helped us out on so many of those and getting creative. And I think sometimes we've given him a migraine with some of our requests.
Yeah, and the beauty of collaborative is we can come up with results that courts cannot, and we can do it in a time frame that's much more efficient than the court system, especially if you're going to adjudicate some of these issues at trial. We're still applying the legal model. Everybody's still getting proper disclosure and independent legal advice. You're just crafting creative solutions. Is that right, Carrie?
Yeah, absolutely.
Yeah. All right, so let's talk about some practical considerations. This has been a great discussion this afternoon. Jason, if you own a business, do you have to get an income assessment done as well? What's your recommendation?
We sort of mentioned income assessment earlier, but I mean, it's important to remember income's needed for support purposes, right? And income for support purposes is calculated in accordance with the federal child support guidelines. And income in accordance with those guidelines is this gross employment income equivalent. So that means it becomes tricky when there are businesses involved because all the benefits from business ownership, whether it's paying related parties for income splitting purposes or having the business pay personal expenses, and even keeping income in the business and not drawing it out, all of those are benefits that need to be taken into consideration in income that's available for support purposes for a business owner. So when there is a business interest, I think that yes, you do need an income assessment from a CBV to ensure that sort of income is calculated in accordance with those guidelines and includes those benefits. Because
Okay,
they're not reported, right? They're not on the tax return.
that's right. You want to add those back in, maybe gross them up too, right? So you add another 30-40% on top of it. Just
Yeah,
sprinkle a little bit more in there, right, Jason?
that's right. And they love that. Business owners love that because now their income that they have to pay support on is so
Yeah.
much higher than the income they think they're really getting. They love it.
Oh,
Yeah.
yeah. It's a tough sell for sure. Um, I noticed Daphne put in the chat a link to the CP training. And so if you're interested in getting the training done, thank you, Daphne, for sharing that. How do you minimize the impact of divorce on your business or your client's business? What tips do you have, Jason?
Yeah, that's what we're trying to do, right? We talked about all the negative effects of divorce on a business and how do you minimize that? I think, we've talked about this, but the first thing is just be as open, honest, forthcoming, and transparent as possible throughout this process. If you want to minimize the time you spend in the divorce proceeding and minimize the negative impact, just be open and honest. And Carrie and Russ have talked about using the collaborative approach to staying out of court. That's going to be your best bet of minimizing the negative effects. Use the collaborative process, stay out of the court system.
Agreed.
Tips for achieving fair settlements and safeguarding your business. Well, you've heard Carrie talk about the golden goose, right? This is an asset that can continue to generate wealth for the family, whether it's separated or together. So you want to be mindful of that and think, okay, how can we preserve this asset, this thing that's going to keep providing for the spouses and for the children, potentially provide a legacy. And certainly collaborative is one way to do it. I think bringing in experts like Carrie and Jason adds credibility to the process. So this isn't lawyers just exchanging document briefs. These are professionals looking at the documents, looking at the source documents, consulting with both spouses. I've had a client who didn't trust a thing her husband said and what was out for vengeance. She wanted retribution. That was not our job, but that's what she wanted. She thought somehow she'd get it through the divorce process. And there was issues of cash and hiding income and all the rest of it. And we sat down with her, we went through the ledgers. Jason did a detailed analysis, and she had all the points that she witnessed during the course of the marriage and looked at the books, and some of it rightfully should have been added back in and grossed up. Some of it were legitimate expenses. But having that process and having a neutral like Jason or Carrie gives credibility to the data, which means the clients are more likely to accept your advice and think the result is fair. The other thing we want to be mindful of is when you should be mindful of the use of fairness. What may be fair to Carrie may not be fair to Jason. It's very subjective. So we try to focus on results that are acceptable. This is an outcome that is acceptable to you. May not be within your definition of fairness, but that would be, sort of a mind shift in terms of how you approach the outcome. In terms of co-owning spouses and adult children, Jason, what do you think about that issue?
Yeah, so if you have co-ownership, I think, some considerations when the business is jointly owned by the spouses, co-owning spouses, is are they both active? You want to find out that who's really involved in the business. Is it both of them or just one? Who's going to own and continue to operate the business going forward after the settlement? So who is going to be the buyer? Who is going to be the seller? Because remember, there's opposing biases there. Seller wants a high value, buyer wants a low value. The likelihood of agreement is very low. You're gonna need an independent valuation in those situations. I think there are some potential solutions to address these challenges, but they're difficult. And the first one involves the parties being proactive, and that's to have a shareholders agreement, like we talked about earlier. Have a shareholder agreement with bio clauses and clauses for regular valuations done in the normal course, so you can preempt any potential dispute or conflict. And the only other potential solution is sell the business and split the proceeds.
Yeah. All right, we're going to bring this train into the station and go to some Q&A. But before we do that, we always have to talk about the Greek chorus, right?
Yeah.
And the not so silent business partner. They're out there. Carrie, what's the Greek chorus and why does it keep mucking everything up?
It's those people in your lives, they're so well-intentioned and they just make a mess of things. You have to remember that just because your brother's sister's friend from work's dog's cousin, whatever, got a certain deal, it doesn't mean that's your deal. And that no families are the same, no businesses are the same, and that they may be similar, but they are not the same. Your result is going to be different. So although their advice or their things may be well-meaning, one of the best things you can say to those people giving you their unsolicited advice, you say, thank you so much. Let me take that question back to my legal team and shut it down. We're looking after your business in your best interest. What they did is a total different story.
Jason, any thoughts about the Greek chorus?
Nothing to add, no.
I would say for the not so silent business partners, consider that an opportunity, right?
Mm.
Perhaps this is a potential solution to resolving an ownership issue or doing an asset swap. Maybe they can participate with their capital or make a further investment to help offset any assets that may be going on in the equalization process. But I see our host Daphne is back. Welcome back, Daphne. That means it must be almost time for Q&A.
Yeah, thank you so much. What an incredible discussion so far. We do have a few more questions if you guys are ready to get into that.
Yeah, for sure.
Okay, so what methods are most commonly used to value a business and how do they apply in a divorce case?
Jason, what do you think is most common?
Yeah, any evaluator will tell you there's three sort of fundamental approaches to valuing a business. It's the asset-based approach, which is largely balance sheet driven. There's the income-based approach, which is largely future cash flow or income. This company's generating annual income and it's discounting those future cash flows. So income-based or market-based approach, which is looking to the market, looking to comparable companies actually being bought and sold in the marketplace to give you an indication of what the company's worth. In terms of how they're used in a divorce setting, I mean, those are fundamental valuation approaches used in any purpose for evaluation. So equally so in a divorce.
What do you think is the most common one you see, or are they all equal?
Most common is the income-based approach.
Right.
That's the fundamental premise of values. You're looking at the specifics of this company and you're predicting what it's going to be able to generate in the future for in terms of annual income, and you're present valuing that income. That is largely the most common valuation approach for valuing a private company.
Thank you. Another question here is, what role do tax implications play in business valuations during divorce settlements?
Carrie, Jason, I guess you got to consider taxes, right?
Taxes all over the place at every step of the way, at the corporate level, at the personal level. It's always looked at.
I think the easiest way to look at this, you can never contract out of the CRA. It doesn't matter what you say, what you want to do. You can't contract out of them. They're going to come at you for their money. They are really mean people that way. I don't like
You also have capital gains you got to consider and a whole bunch of other taxes too, right?
everything. Like there's nothing that's off the table, I think, when we're looking at taxes.
Now, yeah, when you value the shares of a company, you're looking at after-tax cash flows. It's after tax. And when you're looking at assets the company holds, if they're redundant assets, it's the net realizable value. So it's the net value of those redundant assets after tax. And then even when you have the shares of a company, an individual owns the shares of the company. In order for them to dispose of the shares, yeah, they may be able to shield tax if they qualify for capital gains exemption, but chances are they're going to have to pay taxes if they decide to sell the assets and distribute a dividend. So there's tax considerations at every level.
It's a whole nother presentation, I think.
Yeah.
Well, you know what they say, there are only two things certain in life, death and taxes.
Thank you so much.
On that cheery note, what's our next question?
Next question is, what are the potential impacts of spousal support or alimony on the valuation of a business?
Yeah, I think
Aren't those separate? Aren't those separate issues?
I think unless somebody's going to buy the value of the business and earn that income, then that would attract potential child or spousal support claims. But I would treat those as separate issues. Carrie?
Yeah, I would too. I think maybe what's being asked here is that, that income assessment or determination, and that's what we're looking at here. And those things that kind of get added back into an income where somebody's going, wait a minute, I don't actually make that much money. I don't pull that much out of my corporation. So I think that's more what's going to happen here. And it can have a big impact. We see a lot of people that, especially the payor, having a difficult time with that. But it's
Yeah.
also a really good way for us to look at things like lump sums and things like that and other ways that we can structure support.
Yeah, one more, Daphne?
That was all I had,
Okay,
actually.
I'm gonna go to our, let's see, there's one that came in a little bit earlier. Let's see if I can pull it up. What if there are two different business valuations by each spouse based on each one's assertion of the final data separation? Well, if you don't agree on the data separation, guess what? You're gonna have a little trial. Or you need a mediator arbitrator to summarily first decide what the data separation is. However, we've had cases where there's two different dates of separation. We do two different valuations. There's not a big spread. It might be $10,000 or $20,000, and when you divide it in half, you're down to 5 or 10. So there's room to negotiate and wiggle a result out of that because you're going to spend more than that on your legal fees having a hearing. So you want to be practical too. You know, if the date's off by a few days and there's no, or a few months and there's no significant shift in the market or the asset, really doesn't matter what the data separation is at that point.
My
You're
first question is always why? Why don't you agree on the data separation? What's behind that?
well, there's usually some evidence you could produce to demonstrate that you have the correct date. You know, there's a text message from the spouse saying it's over and I'm not reconciling, or a demand letter from a lawyer. Maybe they did reconcile. I don't know. There's lots of reasons why, right, Carrie?
Oh, of course.
Yeah.
But when we're looking at business valuations, is the why because somebody wants an earlier date because, a deal was closing and they don't want that deal being a part of it? Is it somebody wants a later date because they know a deal is going to be closing and they do want it to be a part of it?
Yeah.
Like, and I think sometimes us finding out the why and saying, well, it doesn't matter to be included anyways because the deal was brokered during the time of the marriage. Then everybody goes, oh yeah, and then that date's fine. I don't care what date it is anymore. So I think just knowing some of the whys is a really big help in eliminating that issue.
If your spidey sense is suggesting there's some mischief going on, you may want to take a deeper look for sure. Yeah. Okay, let's bring this train into the station, Daphne. Thank you so much.
Okay, thank you so much, everyone, for a wonderful discussion. Carrie and Jason, you guys are the pros, always sharing a wealth of knowledge and insight. So thank you so much. And Russ, thank you for hosting and allowing me to bring the train into the station.
So remember, we've got our summit coming up in September. Early bird registration ends at the end of August. Sign up. I think we've sent you some information on that. CP training, there's a link there. We'll send you some follow-up information in a follow-up email. You'll get a survey. Please complete the survey. It helps us understand how we can do things better. If you have topics that you want to cover us to take a look at, we'll take a look at those as well. So thank you for attending, everybody in our audience and online via YouTube Live. And thank you, Jason and Carrie, such a wonderful presentation today. I've learned a lot. I learned every time we do some one of these, I learned something new or that I did wrong last week. I'm gonna have to
Same.
So have a good afternoon, everybody.
Thank you.
Thank you.
Thank you,
Thanks,
Daphne.
everyone.
Bye now.